O-Day is Wednesday, 14th of May 2025 Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights. In today's market activity, a mixed momentum was observed, with technology stocks taking the lead in driving gains across major indices. The tech sector's performance underscored investor confidence in the ongoing innovation and robust earnings reports that continue to bolster the sector's outlook. This optimism, however, was tempered by lingering global uncertainties, which have kept investors on their toes. Key indices displayed a generally positive trend, reflecting the broader market sentiment buoyed by tech giants' performance. Yet, the underlying mood was one of cautious optimism. Investors remain vigilant as geopolitical developments continue to cast a shadow over global economic prospects. These uncertainties have led to periodic fluctuations in market confidence, impacting both equity and bond markets. In the realm of commodities, prices reacted to these global tensions, with some commodities seeing increased volatility. Energy markets, in particular, have been sensitive to geopolitical cues, which have led to fluctuations in oil prices. Meanwhile, precious metals, traditionally seen as safe havens during times of uncertainty, have experienced varied movements, reflecting the complex interplay of global economic factors. On the currency front, exchange rates have been influenced by these broader geopolitical developments, with the US dollar showing resilience against a basket of major currencies. This strength is partly attributed to its status as a safe haven, as well as the relative stability of the US economy compared to other regions facing more pronounced challenges. Overall, while the tech sector's strong performance provided a bullish impetus to the markets, the broader landscape remains fraught with uncertainties that investors must navigate carefully. As geopolitical tensions continue to unfold, their impact on financial markets will be a critical area for investors to monitor closely in the days ahead. The performance of global indices reflects a mixed landscape in the financial markets, with varied movements across different regions. In the United States, the markets show a divergence in trends. The S&P 500 has moved up slightly, indicating a cautious optimism among investors. Meanwhile, the Nasdaq Composite has seen a more pronounced increase, suggesting strong performance in the technology sector, a common driver for this index. In contrast, the Dow Jones Industrial Average has experienced a decline, pointing to some weakness in the industrial segment or potential profit-taking after previous gains. The Russell 2000 Index, which tracks smaller companies, has posted a modest rise, signaling some positive sentiment or speculative interest in smaller cap stocks. The VIX, often referred to as the Fear Index, has edged up slightly, implying that market participants are still somewhat wary about future volatility, though the increase is not dramatic. In Europe, the FTSE 100 has barely budged, indicating a day of consolidation with no major drivers to push the market significantly in either direction. The DAX in Germany has slipped, reflecting some concerns or potential headwinds facing the European economic powerhouse. Asian markets present a contrasting picture. Japan's Nikkei 225 has recorded a minor decrease, perhaps indicating caution amid global uncertainties. Conversely, the Hang Seng Index in Hong Kong has surged significantly, possibly buoyed by positive developments in the region or favorable economic data. The Shanghai Composite has also shown a healthy gain, suggesting some confidence in China's market dynamics or policy measures aimed at stimulating growth. Overall, the varied performance across these indices underscores the complex interplay of regional economic conditions, sector-specific developments, and investor sentiment, all of which continue to shape the daily movements in global financial markets. In the bond market, yields have presented a notable shift, reflecting investor sentiment and broader economic conditions. The 10-year Treasury note, a key benchmark for long-term interest rates, is yielding 4.499%. This figure suggests a continued upward trend, indicating increased investor demand for higher returns in the face of potential inflationary pressures or economic uncertainty. The 3-month Treasury bill yield is at 4.285%, which, while slightly lower than the 10-year yield, still represents significant short-term yield levels. This suggests that investors are seeking safer, short-term instruments amidst prevailing market volatility, as short-term treasuries are often viewed as a refuge during uncertain times. Meanwhile, the 30-year Treasury bond yield stands at 4.943%, marking it as the highest among the observed maturities. The steep yield curve, demonstrated by the differences between the short and long-term yields, typically indicates expectations of future economic growth and inflation. However, the elevated yield could also reflect increased risk premiums as investors demand more compensation for committing their capital over longer periods. The marginal differences in yield growth percentages across these maturities underscore the nuanced investor perspectives on liquidity, risk, and future economic conditions. The movements in bond yields are crucial for both investors and policymakers, as they influence borrowing costs across the economy, from mortgages to corporate loans. These yields are also a reflection of the Federal Reserve's interest rate policies, as the central bank's stance on inflation and economic growth heavily influences investor expectations. As the bond market continues to navigate these complex dynamics, yield trends will remain a critical indicator of market confidence and economic outlook. Investors will closely monitor these developments, adjusting their portfolios to align with the evolving interest rate landscape and perceived economic trajectories. The currency market displayed a mix of movements today, with the US dollar index showing a slight decline. The index, which measures the dollar against a basket of other major currencies, fell by approximately 0.52%, settling at 100.482. This decline indicates a weakening stance of the dollar in the global currency markets, possibly influenced by recent economic data or adjustments in interest rate expectations. Conversely, the euro saw an uptick against the dollar, gaining around 0.46%. This rise suggests a strengthening of the euro, which could be attributed to positive economic developments in the eurozone or diminishing concerns over potential economic slowdowns. The euro's increase reflects a shift in investor sentiment, possibly favoring European assets or reacting to central bank policies that contrast with those in the United States. The Japanese yen experienced a notable decline, dropping by approximately 0.69% against the dollar. This movement might be connected to Japan's ongoing economic challenges or the Bank of Japan's monetary policy stance, which tends to keep interest rates low. The depreciation of the yen could also be a reaction to increased demand for the dollar as a safe haven amid global uncertainties. Meanwhile, the British pound experienced moderate gains against the dollar, rising by about 0.29%. This could be attributed to positive economic indicators from the UK, or market expectations surrounding the Bank of England's monetary policy. The pound's appreciation suggests a relatively optimistic outlook among investors regarding the UK's economic prospects, possibly driven by recent economic reforms or trade developments. Overall, today's currency market activity highlights the dynamic nature of foreign exchange, where geopolitical events, economic data releases, and central bank policies play pivotal roles in influencing currency valuations. As investors continue to navigate these factors, currency volatility may persist, offering both challenges and opportunities within the global financial landscape. In recent trading, the commodities market has demonstrated a mixed performance with notable fluctuations across key segments. Gold, a traditional safe haven asset, experienced a modest decline of 0.33%, closing at 3237.0. This movement suggests a slight retreat in investor demand, possibly reflecting a stable geopolitical climate or reduced inflationary pressures, which typically drive gold prices upward. Silver followed a similar downtrend, albeit slightly less pronounced, with a decrease of 0.26% to settle at 33.015. The performance of silver often mirrors that of gold, though it can be more volatile due to its dual role as both a precious and industrial metal. The decline might indicate subdued industrial demand or market sentiment shifting temporarily away from precious metals. Crude oil prices also saw a decline, with both West Texas Intermediate, WTI, and Brent crude falling by approximately 0.53%. WTI ended the session at 63.33, while Brent was slightly higher at 66.28. The synchronized drop in oil prices could be attributed to several factors, including concerns about global economic growth, fluctuations in supply due to geopolitical developments, or adjustments in OPEC+ production targets. Additionally, continued uncertainty in energy markets, driven by the transition to renewable energy sources, might be influencing investor sentiment. Natural gas prices experienced the most significant decline among the commodities, dropping by 1.65% to 3.587. This sharp decrease could reflect seasonal shifts in demand, particularly as the Northern Hemisphere moves away from peak winter heating demand. Additionally, fluctuations in supply dynamics, such as changes in production or storage levels, can heavily impact natural gas prices. Copper, often seen as a barometer for global economic health due to its widespread use in construction and manufacturing, posted a slight gain of 0.03%, reaching 4.7245. This modest increase might signal some resilience in industrial demand or optimism about economic conditions in key consumer markets. Overall, the commodities market showcased a mixed bag of performance, with various factors including economic indicators, geopolitical events, and seasonal demand patterns, influencing the current pricing landscape. Exchange-traded funds, ETFs, continue to play a pivotal role in investors' portfolios, offering diversification across sectors while providing exposure to specific market segments. The recent performances of key sector ETFs highlight the varying investor sentiment and market dynamics across different segments of the economy. The technology sector, typically a bellwether for growth prospects and investor risk appetite, demonstrated strong performance with the technology-focused ETF up by 2.16%. This rise can be attributed to the robust performance of several leading tech companies, buoyed by advancements in artificial intelligence, cloud computing, and digital transformation initiatives. Such trends continue to attract significant capital, betting on sustained growth and innovation. Conversely, the healthcare sector experienced a notable decline, with its ETF dropping by 3.01%. This downturn may reflect investor concerns over regulatory changes, drug pricing pressures, or disappointing earnings from key healthcare firms. As the sector navigates these challenges, investors appear cautious, potentially reallocating capital to more promising areas or waiting for clearer signals regarding future policy implications. The energy sector showed resilience with a 1.41% increase, underpinned by factors such as rising oil prices and optimism about global energy demand recovery. The energy market's volatility, driven by geopolitical tensions and supply chain disruptions, often makes this sector attractive to investors seeking short-term gains or hedges against inflation. In the realm of innovative growth, the RKK ETF soared by 5.38%, highlighting investor enthusiasm for disruptive technologies and companies positioned at the forefront of innovation. This surge indicates a strong belief in the long-term potential of sectors like biotechnology, autonomous technology, and fintech, despite the inherent risks associated with early-stage companies. Overall, the varied performances of these ETFs underscore the importance of sector diversification and the need for investors to stay informed about macroeconomic trends, industry-specific developments, and company fundamentals. As markets evolve, ETFs remain a dynamic tool for capturing broad market movements and targeted sector opportunities. The stock market displayed a mixed performance today, with notable gains in the technology and energy sectors, while healthcare and consumer goods experienced declines. Among the top performers, Nvidia posted a substantial increase of 5.63%, continuing its momentum as a key player in the semiconductor industry. This surge could be attributed to robust demand for its graphic processing units and advancements in AI technologies. Likewise, Oracle saw a strong rise of 3.21%, reflecting positive investor sentiment, possibly driven by its cloud services growth and recent strategic partnerships. In the energy sector, Diamondback Energy and Chevron posted gains of 2.27% and 0.52% respectively, benefiting from recent upticks in oil prices and increased output expectations. ExxonMobil also inched up by 0.27%, suggesting stable performance amidst fluctuating crude markets. Conversely, the healthcare sector faced pressure, with United Health Group experiencing a significant decline of 17.79%. This drop might be related to concerns over policy shifts or earnings misses. Similarly, Merck and CVS Health fell by 4.72% and 6.65% respectively, likely reflecting broader sector challenges and regulatory uncertainties. Consumer discretionary stocks like McDonald's and Procter & Gamble saw declines, with McDonald's down by 1.04% and P&G by 1.35%. This could be indicative of market apprehensions regarding consumer spending behavior amid economic uncertainties. Nike also dipped slightly by 0.30%, potentially due to competitive pressures and foreign exchange impacts. Despite these sector-specific movements, the financial sector showed resilience. Goldman Sachs and Bank of America recorded gains of 2.11% and 2.12% respectively, potentially benefiting from favorable interest rate environments and strong earnings reports. American Express also rose by 1.13%, underscoring its strong credit card and services business amidst a fluctuating economic landscape. Overall, today's market activity highlights the dynamic interplay of sector-specific drivers and macroeconomic factors influencing investor behavior and stock valuations. The technology sector has demonstrated a robust performance, underscored by significant gains across multiple major players. Notably, Palantir Technologies emerged as a standout, registering an impressive surge of over 8%. This positions the company as a leader among its peers in terms of percentage growth, reflecting strong market confidence in its data analytics capabilities. Nvidia and Tesla followed suit with commendable gains of 5.63% and 4.93% respectively. Nvidia's growth continues to be driven by its dominance in the GPU market and the burgeoning demand for AI-driven applications. Tesla, on the other hand, maintains its upward momentum as it capitalizes on advancements in electric vehicle technology and expanding global market presence. Advanced Micro Devices also showed solid performance with a 4.01% increase. The company's strategic product launches and competitive positioning in the semiconductor industry have bolstered investor sentiment. Similarly, Uber, reflecting a 4.11% rise, continues to benefit from its diversification into food delivery and logistics, which have become critical growth areas. In the semiconductor space, Taiwan Semiconductor Manufacturing Company and Intel posted gains of 3.75% and 1.71%, respectively, highlighting the sustained demand for chip manufacturing despite broader supply chain challenges. ASML, a critical player in the semiconductor equipment market, rose by 1.83%, underscoring its role in enabling technological advancements through its lithography solutions. Meanwhile, Salesforce and Zoom saw marginal increases of 0.12% and 0.62%, respectively, Salesforce's steady performance is indicative of its strong enterprise software ecosystem, while Zoom continues to leverage its platform's reach in the remote work era. Conversely, Microsoft and C3.ai posted slight declines, with Microsoft experiencing a minimal dip of 0.03% and C3.ai dropping by 0.87%. Microsoft's slight downturn may reflect profit-taking activities, despite its dominant position in the cloud computing and productivity software markets. C3.ai's decline suggests potential market concerns about its path to profitability amidst intense competition in the AI sector. Overall, the tech landscape remains dynamic, with companies strategically navigating market opportunities and challenges in an ever-evolving digital economy.